Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. All right, Zane, welcome back to the Energy Desk, first one of 2025. How's it going?
Great. It's good to be back. Always nice to have a week off, gather your thoughts, and nice to come back with some excitement for both crude and gas.
Yeah, I have a few things to talk about. I think one of the things that we left off our last episode for listeners was the low liquidity risks for the holiday break. Kind of had some weird Wednesday holidays there, so had some of that, and then some weather and other things taken off. So I'm curious to hear maybe your version of the last week and a half.
Well, leading up to the Christmas holiday, it was getting exceptionally mild across the lower 48, and really that period from Christmas through January 2nd was the most pronounced. That EIA reference week was the hottest such week since 1950. And then here we are as we come back from the Christmas week into the New Year's holiday week. And on Monday, December 30th, we see the front month contract jump up to a remarkable $4.20. That rally is unequivocally due to colder weather that is now forecast to blanket the most of the lower 48, or I guess I should say the eastern 2/3 of it. And as this week progresses, meaning the week that starts today, January 3rd, it will be more east-centric than a eastern 2/3. But it's certainly driven some excitement in the market, like what's the potential for withdrawals with more than 240 HTDs per week for the next couple of weeks. So certainly some excitement. However, here we sit on Friday, January 3rd at, 11:38 a.m. Central Standard Time, and the February contract is trading $3.39. So the panic rally, like you mentioned, low liquidity, and then maybe some more, I don't know, it's hard to say whether it's rational thinking or it's just the prevailing negative sentiment that has plagued the natural gas market for at least the last 2 years, and I think many would say all but 1 year in the past decade.
Yeah. And so with the cold weather, where are we looking on the inventory side, weather adjusted and maybe relative to last year?
It's kind of hard to make a case for anything too far below 1.7 TCF. I think 1.6 to 1.7 is a rational end of March inventory expectation at this point. But rather than focusing on just the end of season, I think there's a couple of interesting data points just reflecting a little bit. Think of it more like a year-end recap. At the end of 2023, we had a 585 BCF year-over-year surplus. So we were ending the year with a substantial amount of extra gas. Now, to be fair, that stacks up against year-end 22, right? Doing the year-over-year comparison, which was the lowest year-ending inventory level in the shale era at 2.9 TCF. But fast forward to the latest inventory data, that being released today, and we'll call that end of the year, although there's theoretically a few more days in December included in the Jan 2nd storage number. We are at a 63 BCF year-over-year deficit. So 585 surplus to 63 BCF deficit, and we've got 3.4 TCF in the ground. Once upon a time, 3.4 TCF at the end of December would have been seen as too much. And I think in some ways the market is still suggesting, maybe too much by backing away so much from the early week highs. However, the shift from such a substantial surplus to a deficit and looking forward at a forward weather forecast, I think I just used the word forward twice. Redundancy, why not? We're getting started here in the new year. Looking forward, it's reasonable to believe we could have a 1 TCF withdrawal in the month of January. And now you've got the the month of February starting, if that proves to be the case, and you're already down to the inventory level that, theoretically creates the panic, and we've got too much with 2 more months of withdrawals to come.
Right.
The last piece, this inventory situation is kind of interesting to me. The other one that I think really stands out as a relevant data point is the fact that we've already had now 3 triple-digit withdrawals this winter, or just through the end of the year. Certainly after what will be a very paltry withdrawal in this record-setting mild New Year's week, we'll go into a period where it's almost guaranteed that we'll see successive 200 BCF withdrawals. How far over that mark remains to be seen. And then how does that compare to the last couple of years? Well, the last 2 years have been equal in terms of triple-digit draws. There have only been 5. So we're already at 3. We haven't gotten into peak winter yet. And then over the past 2 winters, last year, there was only 1 withdrawal greater than 200 BCF. And the winter before that, winter 22-23, there was only 3 200 BCF or greater withdrawals. Yeah. We could get 3 of those in a row, and likely should. So, I think that the stage is set for some fireworks. Mother Nature always wins. If the cold in the forecast dissipates, mind you, it's been since 2011 it was the last time we saw January start cold and end cold. So the market really doesn't remember what it's like to have a consistent colder than normal pattern in January.
Another spot that does not remember a winter without something is what's going on in Europe right now. We have the end of the Ukraine Gazprom gas transit deal. Just kind of before digging into the details, what are your kind of high level thoughts on that relationship right now, and maybe how it's affecting kind of the global sentiment?
Yeah, it's really interesting to who cries uncle in this deal, or if it's just a elongated stalemate like we've seen in some ways with the military conflict. I'll let you cover the details of the deal and the impacts on European supply, but I think just the obvious takeaway right now is the rebound in TTF pricing as a result of this. The February TTF contract traded as low as $12.70 in mid-December. Yeah. And it's back over 15. And even more interestingly, it's almost 80 cents over the corresponding JKM contract. Yeah. So I think that's flipped on its head.
Yeah, I think that'll be kind of an interesting way to come back to it. So just for some of the details for listeners, we have this Gazprom Ukraine transit agreement, a 5-year deal, expired overnight going into January 1st. It's kind of by the end of the year averaging about 1.3 to 1.5 BCF a day, and that's mostly routing through Ukraine to Slovakia and then on to Austria and the Czech Republic. So this is not really a big risk for Western Europe directly, but I think it's going to be kind of interesting to see how Germany getting rid of their levy on their storage levy to make it easier for foreign buyers to import from Germany, which is the Czech Republic's plan to then supply Austria. But I do think that this is kind of an interesting one, because then the very next day we have a compressor failure at a Equinor LNG facility supposed to last through January 9th, and you lose another, about 0.6 to 0.7 BCF a day, and then you get another reaction in TTF. And, we've covered this before. It's for Europe total, it's pretty moderate share. It's only about 5 to 8% that Europe was getting through this pipeline. But, I think as you pointed out with TTF and JKM, I think that there's maybe some interesting consequences going forward, and I'm curious what your thoughts are on kind of the new landscape for Europe on the gas supply side. Is this going to be just kind of a perennial competition, Asia LNG, or is there something else that people should be thinking about?
I mean, yeah, I think logically they should have to compete for the molecules. In theory, though, neither Europe or Asia has the ability to satisfy daily demand. Certainly with colder than normal weather, the deliverability out of storage facilities that are whether it's, taking regassed LNG cargoes and storing them underground, or, in Europe's case, or just in Asia's case, predominantly just regas to consumption. Neither one of them can meet daily demand. And logically, the route that LNG takes to get to Asia is longer than an LNG molecule making its way to Europe. So Asia should trade over Europe consistently. However, this, from really throughout Q4 and certainly at present, at the widest spread between TTF and JKM, you're seeing the concern in Europe, which is understandable. The marginal molecule always sets the price. So while, like you pointed out, it may not be a substantial quantity of total European, delivered supply to the consumer, it's that marginal unit that sets the price, and up we go. I long term, what's the relationship? I don't think anybody really knows yet, and I'm not even going to venture a guess. We don't know what a world looks like with colder than normal temps for any consistent period in Europe or Asia without the flow molecules on Russian pipes to Eastern Europe.
Yeah, and really Europe now, from the supply side, they're going to be looking at Qatar and US and Norway a little bit for the LNG side, and then pretty much relying on Norwegian pipes for the balance. And is there anywhere else that is going to be kind of the primary supply for Europe?
I think that's it. Those are the keys. Certainly, it's possible that Trinidad's LNG production could be revived and back into some meaningful growth mode. Doesn't really get talked about much at all. And I think there's even some debate on what the productive capacity down there is anymore. But it is Qatar, it is the US, and it is piped gas to some extent. The one thing that I think will be interesting to follow is, do we just see a shift away from Ukraine and more of a southern route for Russian pipe flows? Does, I'm going to draw a blank, or I'm going to make a mess of the name, but at the Turk Stream, I think is the name of the pipeline.
Turk Stream,
do you just see more of a build out where you go through a country ultimately on the way to Europe, but somebody that Russia deems a better partner, than, but well before the current Russia-Ukraine, military conflict, there's been this issue between Russia and Ukraine regarding the transport of gas, thus the whole build out of Nord Stream 2 in the first place. We're going to skip you guys. We're going to go under the water, and you don't think you're playing fair. So do they just find another neighbor that they believe is playing more fairly?
Right. Yeah, and I think it's also important just to note that the loss of the pipeline gas does not mean loss of Russian LNG, which Europe is definitely hesitant to even mention at this point. It does definitely come at an interesting time for Europe's economy. Won't spend a lot of time on that, but I think with Germany's industrial center kind of paying the price for the energy policy of the last 2 decades, probably going to see some more movement there, which could shape up for some interesting stuff for the US. But I think that's maybe a good point to leave that and then go on to the crude part of the world, and specifically looking at US inventories with this week's EIA data and where that came in.
Tell me what you know. What do you think about it?
Yeah, so we got Cushing, the lowest in data going back to 2008. It's about 22.5 MMBs. And then we have total US at about.
So let me pause you for a second there, just so listeners are tracking that. Lowest since 2008, lowest seasonally. We have seen lower. Yeah. So just the clarifying point there. You want to go dig through Cushing data, you'll find a lower data point. But, while there's not as much seasonality in crude as there is in gas, there is still seasonality. So sorry, proceed.
Yeah. No, that's good. And then, total US also lowest seasonally about 10 years. And on the Cushing side, I thought it was kind of interesting. We talked about this a little bit with our colleague Mohit. We were kind of watching this trend for the past few years where you have this ad valorem tax. Didn't end up seeing any of that. I think we talked about it a little bit on previous episodes, but pretty interesting to see Cushing staying lower than normal for an extended period, do you think it matters? Is it kind of just an outdated metric? People watching that as the hub? What are your thoughts?
In a market that's had such a negative bias really for the entire fourth quarter, one might argue even longer, I think it does matter. How relevant is Cushing in the grand scheme of things? Well, it's still the benchmark U.S. price point. So it's got to matter to some degree. And I think what you pointed out, and just a little bit of color, maybe a recap for those that have listened to our previous episode, the ad valorem tax issue. I don't know, we call it an issue. It's just a thing that you mentioned. So Texas has ad valorem taxes, meaning that a barrel of crude that's in the state of Texas might prefer to make its way to the state of Oklahoma, where there are no ad valorem taxes, and you stick it in the ground there so you're not paying on what you're holding on to. And we didn't see that. So Cushing essentially, kind of staying at that same 22 million barrel-ish level pretty consistently, no increases. So I think it matters. Certainly when you've got overall U.S. stocks as low as they are. The one other kind of interesting one though is, kind of pesky in the background. While, there has been a considerable rally at the front of the crude curve, now considerable in a world where it feels like you get excited on every $2 move because we're so tightly range bound. But, this morning, the front month or February TI contract trading over $74, up another dollar day over day. So that's a little exciting, but is a quiet little headwind in the background. And, so we've now kind of beat to death absolute inventory levels. When you look at the changes, so over the past 6 weeks, and I know in a write-up you did on Thursday, January 2nd, you were talking about the string of crude draws. So 6 crude draws in a row, 14.7 million barrels of crude taken out of U.S. stocks since kind of right around the Thanksgiving holiday. And that sounds really exciting. And certainly when you pair that with absolute inventory levels. But then when you look back historically, the 5-year average and the 10-year average, so, pick your metric, that 15 million barrels, let's say, is squarely in between the 5-year average draw and the 10-year average draw for crude stocks. So, it's like, man, I want to get excited about this, but is this really any different than what we normally do? And kind of back to that point of seasonality.
Yeah.
So we started low and we're still low. Is there something sequentially bearish happening? And I think the debate is still out on that, which is, kind of an interesting transition to, I guess, what comes next over, the first few months of the year. And maybe take a shift and I'll throw it to you. We recently got some U.S. production data. What did the good old DOE say about domestic crude production?
Yeah, I think you can probably provide a little bit more interesting color here, but just kind of the details, the data details. We had October coming in with month-on-month production growth of about 250,000 barrels per day, which is the best since 2022. And, I think kind of one of the questions I think is on my mind is some of the conversations we've had about kind of range-bound crude and how that might affect production data in the new year. Is it a one-off, or is this going to be a streak of something more to come?
There is the question of the day. So at about 13.5 million barrels a day, I'm rounding up 50,000 or so, but it's easier with round numbers, especially when you're just listening. 13.5 million barrels a day. Are we on our way to 14.5, or are we going to be stuck at 13.5 for a while, just like we were stuck at 13.3 for what felt like a full year? That's the question. Honestly, it kind of hard to say, in a rallying market with a little bit more backwardation. If we move north of 75, certainly if we press towards 80, one would logically conclude that we're probably at 13.5 on our way to 14.5. Does the world want another million barrels a day of U.S. production? Or can the U.S. even handle another million barrels a day of U.S. production? With the big gaping hole still in the SPR, the answer is yes. But once that's used up, then what? I think, it sounds a little bit like taking it to 20 here. Nice little fair catch. Somewhere in the middle of that flat to up 1 million barrels a day is probably the likely outcome if we're in a, relatively resilient market. That's a subjective statement. Quantify that, please. Quantification equals certainly north of 70, probably closer to 75. It's reasonable to think we could be in the middle of that range for growth on a year-over-year basis in the year starting now. And if we dip below 70, it's probably we made it here, but we'll stay here. And then that leaves us to the, I guess, what comes next. It feels like a soap opera with an episode released once a month rather than once a week or once a day. That being, what does OPEC, what do the Saudis have for us next?
Yeah.
But I don't know. We'll save that for another week. Well, I don't know. Let's just kick the OPEC can down the road a little bit. We'll have more to talk about next week. And let's stay on this side of the world. You've got some interesting stats. I know that you dug up on some of our friends here in the Western Hemisphere. Friends, I use that loosely. We'll start with our least friendly friend.
Yeah.
And let's go to Venezuela.
Yeah, the least friendly friend. So Venezuela crude output. So we have a Reuters report. It's looking at some documents for PDVSA and its joint ventures, saying that there's average exports of about 770,000 barrels per day in 2024, which would be the most since 2019. We have monthly exports in December coming off a little bit. We had some unplanned maintenance and outages that brought that down to 756,000 barrels per day from just shy of 1 million barrels per day in November. And OPEC's reported numbers for Venezuela, we have those at just shy of 915,000 barrels per day in the first 11 months of this year versus 780,000 last year. And I think that Venezuela question is kind of an interesting one within the OPEC realm, especially as we approach the new Trump administration. And kind of this open-ended question for me is just how quickly are we going to see a change to the U.S.'s Venezuelan policy? For listeners who maybe aren't familiar with what's going on in Venezuela, we had this election this year where the U.S. threat was, if you don't hold fair and free elections, then we're going to reinstate sanctions. And we give you a little carrot to say, if you hold those free and fair elections, then we'll open things up for you guys. But didn't get those. Everything points to a little bit of a messy election with Maduro taking the win, despite some poll numbers that said that it was a kind of lopsided opposition victory. Lots of interesting political debacles down there. But I do think that that's kind of the question. And then really my question for you, maybe for the listeners to listen into, is how does that maybe affect the broader market perspective, what OPEC's going to do, and maybe how U.S. production growth fares through that?
I think for those that are, flag-carrying members of the Make America Great Again tribe, the belief would be this is going to be great. We're going to sanction Venezuela. We're going to produce more crude. We're going to find a way to export more crude, and we're going to take more market share. However, I think we'll back up before we switch from the Advent calendar to the inauguration countdown calendar and point out the fact that we reestablished sanctions. If this were live, you'd see my air quote fingers. And the simple fact is the reestablishing of sanctions has meant nothing, just like you pointed out with the production numbers and the export numbers. We just keep on keeping on with very strong production, very strong exports of Venezuelan crude. I think it is reasonable to believe that Trump will have a heavier hand, or that to say, at least the hand won't be invisible like the current one. And you will see a change in Venezuelan or exports, really, I guess maybe one and the same. Clearly from those numbers, most of what they produce is exported. But there's plenty of people that can make up for it. Guyana, which maybe we'll go to next, certainly many members of OPEC. There's the good old US of A, our friends, or as President-elect Trump would say, Governor Trudeau and his fellow PMs, certainly those in the more Western-centric provinces, have plenty of growth potential. So do we need the Venezuelan barrels? I would say no. So we cut them and somebody else steps in. This is a market share discussion more than it is a global over-under supply discussion, unless bombs and rockets start flying, far and wide.
Yeah, so we have Venezuela. It's just, fun with numbers, say about 800,000 barrels per day. And then you have Iran at about 3.5, last numbers top of mind that I can recall. So just kind of for the sake of simplicity, say 4.5 million barrels that are potentially targeted with sanctions. And with Saudi Arabia, you have, I don't know, you'd probably say 1.5 million to 2 million barrels of spare capacity. And then, as you mentioned, with Guyana, I can touch that right now. We have an average of basically 650,000 barrels per day in November, but pretty quickly, that's going to be doubled by year-end 2027. This year, we're going to be looking to add about 250K to that. So probably by the end of the year, 2025, be closer to that kind of 900,000 barrel per day mark for Guyana. And then, as you mentioned, got some room for Canada. But is there anybody else that you'd throw in there? Maybe an OPEC that'd be making up some numbers?
I think the key OPEC members are still UAE, Oman, and Kazakhstan. And I guess maybe if I was going to expand the list a little bit, Iraq, their productive capacity is, clearly we're over what they're supposed to be doing. And in theory, in a matter of days, we should hear that the December numbers were lower because they're supposed to be making up for all the overproduction in 2024. And if that does prove to be true, the rally that we're seeing, and that would overwhelm the small little sequential growth. While it's exciting to us because we haven't seen any in almost 2 years, the market will get going on the upside. However, if we're still overproducing, then it's almost like the little boy who cried wolf regarding the production delays returning the barrels that were promised originally in October, were then delayed for November and December, and now are delayed through March. I mean, it really is Canada, US, Guyana, the other people on this side of the world, Mexico and Brazil. I just don't think we're priced at a level that spurs enough investment to really stimulate meaningful growth. I'll just kind of stick my thumb in the wind and say they're $85 a barrel sort of countries at that level and above. They got some more to give, and $10 lower than that, it's just not going to get it done. Certainly when there's plenty of barrels afloat, you see it with Saudi OSP numbers, and you just kind of got to believe for the same is true for anyone else around the world, that there's something on the water that's trying to find a home other than the pesky strong dollar that I'll let you cover. Even a U.S. barrel's dying to find a home somewhere. So why would you grow if you've got somebody else trying to give it up?
Right. Yeah, exactly. And as you mentioned, dollar, an interesting one this week. Been watching it for the last month or so, but touched over 109, which still that rough, 2 and a little bit high. So since November of 2022, I think that really just looking at that kind of seems more like an indicator of non-U.S. economic fears. So trust that the U.S. economic strength is still going to be the global leader. While in the EU, we're definitely seeing some signs of weakness that probably have some downside skew remaining. And then China is kind of the big unknown. I think China is an interesting one because they've been a little bit more aggressive with their announcements about stimulus. Another one came out today where China is saying that they're going to step up their purchases of ultra long treasury bonds to free up some capital to subsidize consumption. So, I think China's big, long-term concern is, are we the perennial exporter to the consuming regions of the world, or are we going to be able to have more domestic consumption that makes us a little bit, buffered from the economic conditions in other countries? But I think for the crude market, that's another one to just continue digesting because, as we touched earlier, the low inventories with OPEC production offline until end of March, I think that there's maybe some potential for people to start paying attention to what's going on with China, and then also where those storage figures are and where they change between now and March.
I'm going to conclude with I concur, and great synopsis there on things China. I don't know, maybe we shouldn't talk during the week. Maybe we should disagree more, and we should have this like a combative podcast. No, I think it's really good points on China. Jury's still out, doesn't look good. And then I think the other, just listening to you lay all that out, is it that the U.S. is strong, or is it a relative strength? Is it U.S. feels better than anywhere else? I think that's like another ticking time bomb out there in some ways. Like, what if the new plans from a Trump administration lead to a big, albeit momentary, economic collapse? Do the things we see as supportive tailwinds right now in the oil market have to grapple with the gets worse before it gets better path for?
Yeah, I think that's totally in the cards. You have, I think the U.S. manufacturing, hasn't been great for a while, just kind of like global manufacturing, but the services growth, I think that has some potential. But I think really this yield question where you have rates just hanging at elevated levels for over 2 years, where I think you have maybe some businesses feeling that pain, maybe not reflected in unrevised government data. I think that's a big issue, is that the Fed, when they're looking at interest rates, for example, making their interest rate decisions, the data that they're using, I think we can even point to what happened with all the jobs revisions for the first quarter of 23 to the first quarter of 2024. There's almost a million jobs lower than what they stated, which is pretty substantial. So it's stuff, I think themes like that we'll probably see a little bit more of in the U.S. economic data. So maybe not something to hang your hat on from a strength perspective, but as you said, relative to Europe and Asia, maybe a signal of safety and people's desire to lock in some dollars, and driving up a little bit of the demand side for that. So it's shaping up to be an interesting start of the year. I think, where should we leave our listeners for next week?
Let's see. Watch your weather forecasts. If you are a producer, if you are a consumer, how cold's it going to get? Am I going to lose supply? If I'm a consumer, is there a moment where I should be slowing down or shutting down my operations to give it back? Fun week in the spot market ahead. For oil, I think, unfortunately, it's a little bit of a watching the paint dry still. Look for the next OSPs, look for the December production numbers from OPEC, and where does our streak of crude withdrawals end?
Yeah. Well, sweet. Well, I think we've got an exciting few weeks, a couple weeks remaining until we have President Trump inaugurated, and we'll no doubt have a lot of updates between now and then. So I will see you again next Friday.
Sounds good.
Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts, or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.